Welcome to another episode of On the House with Spartan Invest. Today, we are going to be talking about all things interest rates, and we are welcoming our very own Danny Cole to talk to us about that today. Welcome, Danny.
What's up? Good to be here. I'm excited to chat about this again. It's crazy. We were just saying it's been a year and a half since we had this chat, and a few things have changed since then. So,
Just a few, just a few. So we talked about the last time that we had you on to talk about interest rates. It was October of 2023. And, as everybody know, interest rates can impact everything. They can impact from mortgages, business loans, credit cards, savings accounts. And in fact, really, interest rates are influenced by just a complex mix of market forces, inflation, global events, et cetera, et cetera. So, Danny, we're going to take just another deep dive. I'm going to turn it over to you. But just start off with, hey, what are interest rates? Where do they come from? How are they set, et cetera?
yeah. Thank you. So the first thing is, I guess the biggest misconception is that the Fed rate, the Federal Reserve, sets all interest rates. And understandably, like people normally don't nerd out on this stuff. They don't look at it. They just hear, especially in the last 4 years, we've heard more about the Fed rate than ever before. I'm 41, and it's the most I've heard it talked about just in general news.
Mm-hmm.
But we've also had a 40-year high inflation rate, so it's a big deal. And the first thing is like, well, what in the world is the Federal Reserve? What is the Fed rate? All that kind of thing. The Federal Reserve is a private entity. It's not a government entity. And that's one of the biggest misconceptions. They think it's a government entity. But in a very, very simplistic form, the Federal Reserve is slated to keep hiring and employment under control. They're there to keep inflation under control. And they have several levers. And again, it's a very simplistic explanation. They have several levers that they can pull to help their situation, depending on if we're going into a recessionary period or we're coming into a very busy season and inflation is on the forefront. Well, in the last 4 years, we've seen inflation in its highest form. I mean, it's what was it, eight and a
Mm-hmm.
half at the peak, right at 9%, and it was over a
Right.
40-year high. Well, the Fed rate at that time, the Federal Reserve or the Fed rate itself is the rate at which the Federal Reserve sets between banks and their overnight lending. So to make themselves whole. But again, in simplistic form, think about short-term loans. Think about any credit card. Think about any very short-term business loan. Think about anything that you would just go to the bank for and get a small loan for. Okay, that is going to directly be impacted by the Fed rate because that baseline that they set, then the bank is going to increase that so that they can be profitable. Very simplistically, they've got to be profitable, so they're going to increase that just above that baseline. Okay, when it comes to mortgages, a lot of people also saw that. Okay, well, then explain this to me, Danny. When the Fed rate increased, I saw it with my own two eyes. They said we're increasing the Fed rate, and my mortgage rate went up. So it controls
Absolutely.
that directly. And the answer is you are absolutely right. Both things did increase at the same time. But we were going into a very high inflationary environment. We were going into a kind of a busy time in the economy. Money was still cheap at the time. There was a lot of other options as far as investments go. And in that time, you kind of back up and focus on the 10-year bond. And you ask yourself, well, what is the 10-year bond? The 10-year bond is simply a loan to the government. You agree to lend that money to them for a 10-year period, okay? And they pay you a fixed amount back. The 10-year bond, think about it, is the guy your uh, like dad wants you to date, okay? It's the safe bet. Like it's always going to win. It's never failed. He's got a good job, he pays his bills, whatever, right? Well, the 10-year bond is the safe haven, the safe harbor when things are going a little crazy, when we're having fears of recession. That's when you see people flock to the 10-year bond. Okay. Well, when that happens, they don't really have to incentivize investors to come in and say, "Hey, come buy the 10-year bond." The benefit is that it's safe, but the yield rate on that drops because it's an inverse relationship, price and yield rate. Okay. But when things are good, when inflation's on the forefront, there are just other options at bay or at hand. And so people are looking for other options. And the feds over there are the government bonds, the 10-year bond, and they're waving their hands and saying, well, what about us? Because we have debt. We have to pay for this debt. We have to sell these bonds. Okay. So they have to incentivize people to do so. So they'll increase that yield. And that's where you'll see that rate increase. Well, the 10-year bond is, picture it like this, it's the baseline. Okay. So during that same time period where the Fed was increasing rates, where we're seeing a lot of inflation, there were a lot of other options as far as investments out there. So people weren't exactly flocking to the 10-year bond at that time. So that 10-year
Mm-hmm.
bond yield was going up at the same time the Fed rate was going up. So lock and step in that time period, you saw mortgage rates go up and you saw short-term interest rates go up. Okay. The other factor in this pool of funds is going to be mortgage-backed securities. And then you're like, well, why are there so many things, and why are you just throwing more letters and initials, et cetera, at this podcast? Can it be more simple? I'm sorry, it unfortunately cannot.
It is
Um,
very complicated. It's very complex issue on how, trying to gauge and determine where the rate is actually coming from.
Yeah, and not only is, everything's an inverse relationship, and when do people flock to this investment versus another, in forecasting. But the big thing is it's not just the U.S. It's not just our little bubble, because in many cases other countries will invest in the 10-year bond because their situation, may not be as good. They may be going through a little more of a tumultuous time period, and they can invest. But again, that's a safe bet. It's never failed, and I'm not saying it never will, but it's fully backed by the government, the U.S. government. But when you look at the mortgage-backed securities, that is something that was created in the 70s. I think the first, like the federal mortgage-backed security, was in 70. I think Bank of America created a private one in 77. Before that time period, you went the old-fashioned way. You went to Mr. or Mrs. Bank. They checked your credit, they checked your debt to income ratio, they checked everything, and they gave you a loan. So you said, hey, I'd like to buy my dream house. It's $1 million, or I'd like to have $1 million loan for round numbers, and they would qualify you and give you that money, and in many cases service that loan through its entirety. If anything, it's sold to another bank, but they would kind of keep it in house, more or less. Now with a mortgage-backed security, you still go through that same process. Bank A, the first bank you go to, doesn't have quite as much skin in the game now, because what they do, as soon as they sell that to you, they bottle up that loan and 100 or 1,000 or as much as they can, and they sell it to an investment bank. Okay. An investment bank is basically, in many cases, it's going to be Fannie Mae or something like that. It's a government backed institution that's buying up these bulk of loans. Okay. And what they're buying is the rights to the payments. So you got $100 million loan, and 100 other people did. So you've got $100 million there. And all those payments at varying interest rates are now going to this investment bank. And the investment bank's not just sitting back, because they gave the bank the money that they asked for. They're not just sitting back and breaking even. What they're doing is they're breaking that up. They're creating an entity, and they're selling shares. So they sell 100,000 shares of this business. And now every person that buys a share of this mortgage-backed security, they're getting their little piece of the pie. So when person or group pays the bank, the investment bank, they get a said return. Now, even in these situations, there's a little bit more, there's more volatility in a mortgage-backed security than there is in a 10-year bond. As I said before, 10-year bond's the guy your dad wants you to date. Okay. The mortgage-backed security is still deemed very safe. And a lot of the customers that are buying 10-year bonds are also buying mortgage-backed securities. It's a similar pool of people. But in a mortgage-backed security, when these investors are coming in to buy these shares, they are looking for a little more incentive to do so. So they'll take the 10-year bond as a benchmark, and they'll say, okay, I want to bump on that. I want a percent, on a percent and a half, whatever that may be. And the market will push that up or down, right? Because if a group of people within that sold group of funds, if they start paying them off, if they prepay, if they refinance, in that case, your yield on that will decrease. Okay.
Mm-hmm.
So it can become like you may have started out again, round numbers, 10% is what I'm going to get out of this mortgage backed security. But if a bunch of people refinance out of that, you have to reinvest those funds. Your yield may be less, even though it's backed up by Fannie. Okay. So those two things are usually in lock and step. But again, as the intensity turns on with mortgage backed securities, the yield will decrease just like a bond. And so that yield decreases on the bonds and the mortgage backed securities, and you'll see mortgage rates go down. Okay. The gap, the second, there's I apologize, forgot I think it's called the secondary spread. Basically, that's the gap between the 10-year bond and the incentive they give for mortgage backed securities. So again, just it's too late to be simplified, but as those things go up, the mortgage backed securities and the 10-year bond, that's when you'll see the yields. That's when you'll see the interest rates go up on 30-year mortgages.
So, what is the average yield of the 10-year that investors typically see?
Well, it's as far as an average goes. Recently, when you look at the last 5 years, the yield was very low. Like it was
Right.
incredibly low. I mean, virtually nothing because there were other investments, other options, things like that. But then when they started increasing, or the inflation started increasing quite a bit, you saw rates go nearly to 5%. And then as of recent, very recently, you saw rates drop down to about the 4.2, 4.23, somewhere in there. And so I wouldn't call it volatile because it's not a volatile rate, but typically they're very, very low. I mean, because but it depends on the market at hand. But I can't give you an exact 30-year average on that.
Yeah.
But and the the other thing is with these customers, it says a lot. The 10-year bond says a lot about the market as a whole. What are people thinking about the economy? What are they thinking? Things. How are they thinking or looking at it when they're looking at the next 5 years, 10 years, and are they looking for safe harbor? Or are there other options? Because when you
Mm-hmm.
look at again right before the election or right before the end of the year, back in September, the Fed rate was decreasing, but mortgage rates were going up. The 10-year bond was steadily increasing. People were very bullish
Yep.
about the economy and a lot of things that were happening. And then when you hit the beginning of February, and this isn't like a political thing, I don't care enough to make it a political thing. It's just the market talks in that 10-year bond because you saw people worrying about tariffs, you saw people worrying about like inflation, are we going to have a trade
Mm-hmm.
war? And the simple reality is that every talking head on the freaking internet wants to act like they know what's to come, but there's too many factors. And there's people far, far smarter than I ever will be that talk about this and deal with this on a day to day basis. But there's too many factors involved to say, okay, simply put, this is what's going to happen in February or March. It's just,
Right.
there's other countries, there's the 10-year bond. There's just too many factors to give an exact answer.
Well, you definitely don't give yourself enough credit because I think you do a great job of kind of breaking down the interest rate and the Fed and how they all correlate. So if you're looking from just, hey, I'm an investor, I've got another full-time job, I'm not going to keep up with all of these inverse relationships and how they affect each other, et cetera, et cetera. What are the things that you would advise investors to kind of keep an eye out? Because interest rates, like I said earlier, I mean, they can affect everything, whether or not you choose to purchase investment properties, your own personal house, whether you choose to start a business and open a line of credit. I mean, that's,
Mm-hmm.
we've felt that over the last few years drastically as rates increase. So does the cost of capital and the cost of just doing business in general. So what would you say are the things to watch out for outside of the Fed, since the Fed it definitely moves the needle, but it is not the end all be all?
Well, and I'm glad you said that because the Fed itself, like just the Fed rate, doesn't move the mortgages directly, like we mentioned. But the Fed also has other levers that they can pull. And during, prior to 2021, they were doing a lot of quantitative easing. Okay. And this really started taking place in 2008 after the GFC. And when they do quantitative easing, when you or I or an institutional investor comes in and they're looking at 10-year bonds or mortgage-backed securities, they're very cognizant of the yield rate that they're going to get. Okay, it matters. It's an investment like anyone else, whether it's big or small. It's an investment. But when they're doing quantitative easing from a Fed rate, or I'm sorry, from a Federal Reserve level, they'll buy mortgage-backed securities, they'll buy 10-year bonds, and they were buying mortgage-backed securities like, in the hundreds of billions of dollars. Okay, and why would they do that? The answer is they were artificially keeping rates suppressed. Keeping rates were coming out of COVID, and they were scared about the economy. They were still keeping rates down. And what that does is that incentivizes people to get out there to buy mortgages, to buy houses, etc. And again, it's just a supply and demand thing. When mortgage-backed securities are just being bought in hundreds of billions of dollars, and there's a lot of incentive or activity there, that will suppress that rate, the actual yield. And when that yield goes down on those two items, you'll see interest rates. And the Fed rate itself at that time was nearly zero. Okay, so they're all, on all accounts, everything was pushed down. And the other factor is quantitative tightening. When you have quantitative tightening, that basically means that the Fed is they're getting out of that game. They're buying less of or none at all. And when that happens, the market's going to do what the market is supposed to do. It's going to react in a normal way with normal investors and so forth. But so again, the Fed rate's not the end all be all, but keep an eye on, are we in a quantitative tightening or easing period with the Fed? And that's pretty relatively easy to find out. And of course, keeping an idea of what the 10-year bond is and what the yield is on that. If it's going up, again, generally interest rates are going to be climbing. If that is going down, typically, again, there is a lot of investors looking for a safe harbor, and typically interest rates will follow. There are exceptions to every rule, by all means, but those two things are pretty well good indicators.
So I know you don't have a crystal ball, right? And you said all the talking heads, they're talking about like this is what's going to happen, et cetera, et cetera. But this affects what we do as far as selling rental investment properties and just operating capital as well. So we monitor it closely. I know you follow it very, very closely. So what are your thoughts or opinions on kind of where we're going?
Well, we are seeing, I think the last year the Fed decreased, again, the Fed rate decreased 3 times. I think it was 1% or 100 basis points. I believe that's
And
right.
I'm pretty sure we had a bet on that. I can't recall, right? We had a bet on how
I
much
think I
the Fed was
won.
going to drop it, and I think I won that one. Okay, I just wanted to
Yeah,
clarify.
yeah, right. You might have won, but they were wrong. But
Fair, very fair.
no, it's so I mean it's good in some ways to see the Fed decrease rates, and that's what a lot of people are looking for, because yes, inflation is sticky and it's still, it's very sticky. But when you see the Fed decrease rates, they can't be too hasty in that. And what I mean by that
Right.
is they're the kind of the throttle control in the economy in many ways, especially in that short-term lending environment. So if they all of a sudden tomorrow we woke up and they had a Fed meeting and they said, hey, we're going to decrease by 200 basis points, I would say that would be a disaster, because it's going to bring a lot of people back into that market. It's going to make money a little cheaper, especially on the short term. Now, I can't express this enough. The Fed can do all it wants to do, but at the end of the day, the market, the idea of what is to come, will be driven by investors and that 10-year bond. Are they scared? Are they excited? Inflation, times of recession, etc. But it's good to see them trickle that down some. That is a starting point, especially for those short-term funds. And when you look at inflation, I think the latest inflation was right at 3%, so it upticked. And obviously, we don't want to see that. They want to see that 2% number. And they want some inflation. So when you look at inflation, all inflation isn't bad for the U.S. economy, because
Right.
it waters down our debt. And we've got a lot of it. And I'll explain that in just a minute. But so they want that to kind of be watered down and what they have to pay back and basically debasing the dollar there. But
Mm-hmm.
I think in the, it depends. If we see, things come in with Trump's tariffs, if we see a slowdown in the economy, if we see, more inflation, I think that's going to make the Fed hesitant on making any drops or changes there. But if we go into a market and things are looking like they feel that a recession's coming, fear is coming, that will drive a lot of people to that 10-year bond, and that may decrease that rate faster than expected as far as the mortgage rate itself. So, I think in the short term it's going to be steady for a bit, but I think toward the end of this year, I'm hopeful that we'll see some movement in a downward fashion as far as the mortgage rates. But unfortunately, that may come with a few hiccups along the way,
Mm-hmm.
with some fear in the market. And I don't know if it's going to be
Right.
due to tariffs or whatever. Um, there's just, again, too many factors to know.
Yeah, it's so interesting. Like you said, I mean, there's a couple of different things you could have the tariffs, and if it doesn't necessarily slow down, consumer confidence or anything like that, then the Fed's going to hold steady at a higher rate. However, if the tariffs come in and it does uh, affect stocks, and there is more consumer fear, and it does kind of drive a recession or possible layoffs, then the Fed might have to bring that down. So there's, I mean, one thing like the tariffs. We're recording this in March, so they have just started, and so we're not sure how long they're going to last. But just from that standpoint, we're not really sure how that could really affect rates. And like you said, there's just too many factors to try to determine that. Talk a little bit about what you were going to talk about our debt.
Yeah, it's crazy. I done a little deep dive. I mean, nothing crazy, but back in 2020, and just to see where our debt was, and our GDP. So when you look at 2020, our GDP, or gross domestic products, basically putting a price tag on the United States. What are we worth? Our exports, the government spending, consumer spending, and 70% of over 70% of our economy as a whole is consumer spending. So you can imagine why, even that short term interest rate can move things quite a bit because of credit cards, things like that. If people feel like they're suffering on their own personal budget and they feel poorer than they did, and less likely to spend, then that slows the economy down because every dollar I spend helps another company. Every dollar they spend helps yet another company, and it moves that consumer spending needle. So at that time, it was $21.3 trillion dollars as far as the GDP. At Q1 of 2020, coming into COVID and its height, we had a debt load of about 23.2 trillion. So we were pretty close to 100% of that ratio, debt to GDP. Okay, when you fast forward in just 2 years, less than Q4 of 2021, you're looking at our debt load jump to 29.6 trillion. That was Q4 21. And you ask yourself, well, why is that? And a lot of people know there were roughly $3 trillion in stimulus packages. Again, it was grandma hit a scratch off, and it was Christmas, like for everybody. Um,
Right.
so quantitative,
Absolutely. And like not just with the United States. I was kind of global, like every
it
country
was.
did the exact same thing, right? So it was felt globally. It was not just us
Mm-hmm.
that felt the inflation and the rise in debt. That was across the board.
100%. Yeah. And that's another point again, when people look at the GDP and they look at our debt, they all this, sometimes people put their blinders on and they think about the US just sitting on this, we're an island and it's just us, and our good decisions and bad decisions affect or impact just us. Even if we're making bad decisions, we're still the reserve currency in the global economy, which is a big deal. And as people use that, as the US dollar increases in value, what you'll see sometimes is another country, they may be experiencing great inflation as well, but the dollar versus their currency, which in most cases they're both a fiat currency. There's no gold backing it. It's just what country is backing that dollar. So the U.S.
Mm-hmm.
dollar is gaining more value faster than their dollar. So yes, they're experiencing inflation, but they may invest in the U.S. just to get those U.S. dollars, because then it makes them it puts them in a better position. Because yeah, they're experiencing inflation, but the dollar is still stronger than theirs. So there's just a lot of factors when it comes to other countries and how they invest and how they look at America as far as investing purposes. But going back to the debt, that Q4 debt, we saw about a $7 trillion debt increase during that time period. And again, quantitative easing, mortgage-backed security purchases, stimulus packages. But to put that in perspective, when we came off the gold standard, it was in the 70s. Nixon took us off the gold standard, and at that time we had a vault of gold, and if you had a dollar, you could technically trade that in for a little bit of gold. Okay, well, since then and all the way until 2005, our total debt in Q1 of 2005, before the GFC, was $7.5 trillion. In less than 2 years, we almost matched that $7 trillion mark, 2020 and 2021. If you
Mm-hmm.
fast forward to today, our estimated debt's about 36 trillion. So we've tagged on another 7 trillion. So those 2 years, and then until that point, the last three have increased the debt. It's kind of gone hyperbolic. It's been a pretty big increase. But you'll also see the GDP increase. But people do need to look at real GDP, not just the GDP number that's not adjusted for inflation. Because as things get more expensive, you may be selling the same widget and the same amount of widgets, but it's just more expensive because of inflation. So it makes our GDP look better.
Right.
But
It's not necessarily an increase in goods and services.
exactly, you may be selling the exact same amount, but everything's expensive, so you raise prices, so it makes the U.S. GDP look much stronger.
Gotcha.
But,
so with all of the moving parts and all of the different factors and no crystal ball, no way to accurately predict what interest rates are going to do, talk a little bit about Spartan and what we do to kind of offset that risk for investors through our forward commitment.
Yeah, I mean, in Spartan, we're a private company, but very much like the Fed rate or the Federal Reserve, there's times where we have to pull different levers and to make things work. We always have to be cognizant of what the market's doing, what returns look like, how does that impact our investors? Because at the end of the day, if people aren't receiving a return and we're just status quo, we leave everything the same, well, business will dwindle. They have no incentive to invest. Just like we talked about with the 10-year bond, you have to incentivize people. So with that, for about the last year, I'd like to give you a pat on the back for this. I mean, it's an ingenious move because we've been doing a buy down on our interest rates, and it's costly. Honestly, it's quite costly.
Yes, very.
But the method is we'll buy rates down in bulk, and we use specific lenders, and we'll buy a bulk of rates, maybe $1 million, $2 million, just whatever is needed at the time. But it brings the actual 30-year fixed rate down to 5.5%, which again, we've just for a long time been over 7%, 7.5%, and the rates are varying. And our cost to get that rate down to 5.5% sometimes makes you wince just a little bit.
Yes, very much so.
But that 5.5% rate, in my humble opinion, of course, I don't have a crystal ball, but I do believe that, number one, it's fixed, it's 30-year fixed, and it's only 20% down as far as a requirement from our investors. That's a huge, huge deal. There are other options out there, but you might have to put 30% down, and that's quite a bit more out of your pocket. But in my humble opinion, what a 5.5% rate offers you is something that you can feel secure long-term about. I do not think that we're going to be in an environment anytime soon that you're going to refinance a 5.5% rate. If we were doing
right,
6.5%, 7%, a little bit down, then I would say, I don't know. Like it's great, but I'll probably refinance it anyway. And then somewhat near future, right? Rates will eventually drop. But us being in that 4.5% land with investment properties, I do not see that coming anytime soon, right? So
Mm-hmm.
it's a rate that you can feel good about. It's a rate that you can lock in, and it makes these properties cash flow appropriately, right? So
Right.
that's a good long-term buy and hold type number that people are looking for. And again, to only have to come out of pocket for 20% is a very, very big deal because a lot of our investors, they're looking to grow their portfolio. It's not just to buy one and be done and, oh, I bought a share of something. It's very much about buying and increasing your long-term pension, your personal pension that you're creating for yourself.
Yeah, and it's a really good point in that I know a lot of investments in real estate over the last 3, 4 years, as we've seen these rates become very volatile and increase drastically. That it's, hey, we'll buy and then refi later. So I think that's a really good point in that this 5.5 is something that I don't foresee anybody having to refinance in the next 20 years, I would imagine. That's a guess. I don't know. We can bet on that too. Like we can
Yeah,
place a bet on how long it would be before somebody was able to get a 5.5% refi. But well, Danny, thank you so much for joining us today and diving deep into interest rates and where they come from and the Fed. I really appreciate it. Thank you so much.
absolutely. Glad to be here and hash all this out again. Thanks.
All right. And that's On the House with Spartan Invest.